Good afternoon, possibly, or good morning, depending on where you're listening to us from today. Welcome to our latest webinar here at Advanta IRA, titled Finding Certainty in an Uncertain Market. As anyone who watches the stock markets on a regular basis may see, a lot of times there are a lot of up and downs within that type of market. So we're going to talk to today about ways that you can have your IRA, maybe your old 401k funds, working for you in investments that do allow you to sleep better at night, put you more at ease, and have more certainty in the returns that you're generating back into your accounts. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for quite a while now and have seen a number of different types of investments over the years, not only in handling the transactions themselves and helping clients make the investment, but also certainly talking with new people and new clients and new referral sources about the different investments that you can make within a self-directed IRA account. I'm going to be joined today by my colleague, Alex Perney, and I'm going to let Alex introduce himself and get us started.
Thanks, Scott. Yeah, my name is Alex Perney. I've been with Advanta since about 2012, so also been here for quite a while and seen quite a few things. I started my career out helping clients actually structure and process transactions. I was involved in over 1,200 individual different investments in my time doing account management and investments for clients. So I have a lot of experience in kind of seeing boots on the ground and seeing exactly what people are doing with their self-directed accounts and kind of how those things play out. And I also now have transitioned more into an educational and business development role. I also run our podcast, the Alternative Investment Advantage podcast here at Advanta. So I do take a look at a lot of current market trends and try to help bring good education to people. And we're going to kind of get into that today, as well as looking at, what are some of the factors that are driving market uncertainty right now, and, kind of how that correlates to some of the more stability or some of the greater stability you can see when investing in alternative and more tangible assets, things like real estate and mortgages. And we'll get into some specific case studies a little bit later on as well. A little bit about Advanta IRA. We have almost 20 years of industry experience. We were founded back in 2004, kind of cutting our teeth in the real estate market, but we've certainly branched out since then and are involved in everything from single family home real estate investments with client IRAs to private securities to limited partnerships, mortgage lending, and everything else under the sun that's not on a traded securities market. So if you have any questions about some maybe more niche stuff that you're interested in investing in that you think might be a good fit for your IRA, that might kind of get you out of that scope of just being riding the roller coaster that is the stock market, especially in today's climate, certainly do reach out to us and let us know. We're happy to help, and we have a lot of experience in helping clients with exactly that. We also do maintain any type of cash deposit, FDIC insured. So if you are looking to make a move into self-direction, you're not necessarily giving up any of the typical banking security and regulations that you're accustomed to with more traditional wirehouses. So feel confident in the fact that if you are going to do this, you're not necessarily giving up any type of implied security with regard to uninvested cash or any other type of financial situation that you might be in. We have a little bit over $2 billion in assets under management, which is something we're really proud of. We've worked really hard to grow our client base and our administrative assets over the past 18 years, and we have almost 9,000 active client accounts. So that's definitely a good cross section of the market, and for whatever clients are looking to do. If it's out there and is ability and legal to be done by an IRA, we've probably seen it. And another thing that we're really proud of is the really personal touch that we give to administering client accounts and client assets. Every single account here at Advanta has a dedicated client account manager, meaning that you're not calling into a phone bank, you're not talking to someone different for every single transaction you're looking to do. If you want to invest in private stock, you want to invest in an LLC and a trust, you also want to invest in some single family real estate and gold, you're always going to be talking to the same person, which is something that you really don't see anywhere else in the market for what we do. So if you're interested in getting started with this, understand that we have the personal and professional experience to make sure that this is a good fit for you and that you understand and are able to do things that are in benefit to you and your retirement planning. So what is a self-directed IRA? A lot of people are kind of under the impression that it really only falls to, securities markets. There are some larger wirehouses out there that quote advertise a self-directed IRA. Well, while yes, that may be true in the context of you being able to self-direct your IRA into buying Microsoft or IBM or some McDonald's stock, it's not self-direction in the context of what we're talking about. Self-directed IRAs in their truest form offer owners complete control over their retirement funds and investment decisions, and also asset classes that they are invested in. We offer the ability for clients to use their self-directed IRAs to make informed decisions on assets that are outside the scope of the securities markets and offer true ability to get invested into alternative assets, which again creates diversity and helps build retirement wealth. You are investing outside of the stock market and you get to avoid that roller coaster of different things that happen. And we'll kind of get into that here in the next slide. And since the assets aren't publicly traded, again, you do have that buffer for things going up and down with earnings reports and Federal Reserve reports and all these different kind of things that would directly affect the underlying value of your retirement plan assets. And you get to invest for things like long-term wealth, long-term cash flow of your IRA assets, which offers a great degree of benefit to you as the ultimate end-use investor. Now, right now in the stock market, we're seeing high degrees of uncertainty, and there's a lot of things that are factoring into what exactly is going on. Now, we all kind of know that stock market pricing and dividend income can vary widely from day to day, week to week, and month to month. And especially since the very beginning of this year, we have seen a very precipitous slide in a lot of the large market indexes and certain sectors within the market. And we'll kind of get into what is exactly affecting those. Now, what people also need to understand is that if you are trying to invest for cash flow, if you're an older investor and you don't necessarily want to be having to sell chunks of your investments every time you need capital, people tend to like to gravitate towards things that cash flow, things like dividend stocks. Now, dividend stocks are great, but the big downside is that the dividend or the amount of money you receive is directly correlated to share price. You're going to be getting a certain percentage of the actual value of your holdings back in a dividend payment to you. Now, this is all well and good when things are kind of riding that straight up trajectory like we saw, for the past maybe 5 years, previous to 2022, and with the little bit of the aberrant, very big drop that we saw right in the beginning of COVID. People have been fairly secure in the type of cash flow that they can get. But right now we're kind of maybe seeing that ride start to come to an end, the music starting to stop, and people trying to figure out what chair they're going to be sitting in. So it's a good idea to maybe look outside the scope of that. Now, things like market indexes give us a good idea of market health, and almost all of the large ones have seen a relatively large drop in overall value. We're seeing the S&P 500 down a little bit north of 13% year to date, the Dow Jones Industrial Average down about 9.6%, and the S&P mid cap, which kind of focuses on middle market companies, so not your huge blue chip Teslas and everything else, but kind of a good idea of the middle of the market health of the stock market, down almost 11.5% year to date. Now, there's a lot of different things that factor into any of these. We have things going on in the world, such as the ongoing war in the Ukraine. We have different supply chain issues that are continuing to have rippling effects through Southeast Asia. And the issues with that are that these are all factors that are outside of you as the investor's control. You don't have really any ability to control or make a decision that's going to be have a bearing effect on what a government in a Southeast Asian country or what a Eastern European country is deciding to do. These are all outside factors that are directly going to affect the underlying share price and the value of your retirement plan assets in the United States, which is something to be said that if you want to take complete control and have that kind of ability to make informed decisions, you have to have a much larger scope of what you're investing profile is to be able to avoid things like that. And sometimes they are unavoidable, especially when we're seeing things like the Consumer Pricing Index, which is a measure of inflation in the United States, up over 8.5% over the last 12 months. So not only are share prices and values of underlying securities that you might be investing in going down, but also the price of everything else is going up. So how do you counter that? Well, you need to make more money, especially when it comes to retirement, in ways that you can defer taxation or eliminate taxation to help combat that rising inflation. Well, if you're having to worry about things like computer chip shortages coming in to affect the ability of Intel to properly deliver new microprocessors, I think people can see kind of how hard that might be. Now, certainly if you are able to devote a full-time jobs worth of time into studying stock markets and being very informed, then yes, you could probably make some informed decisions and continue to make money even when there is a high degree of uncertainty in the markets. But most of us don't have that. Most of us can kind of focus on a few things that will effectively be what we are, quote, experts in. And a lot of people tend to understand things that are very close to home, things like real estate. Most all of us live somewhere. I doubt many of us listening to this presentation right now are using Wi-Fi in a campsite and aren't especially living like that for the majority of their lives. A lot of us kind of have an inherent understanding of some things that can be very beneficial to invest in, such as real estate. Most people are familiar with, what a mortgage is and can probably parlay that into being able into an effective investment strategy for their IRAs without having to understand all these extraneous market factors that are going to affect the price of the ability for General Motors to sell something and create a profitable structure for their share price to go up when they can't get microchips to put in their cars to actually sell them. So that's something that I like to kind of hammer home when we're looking at just how much of an issue it can be when trying to make a good decision in a securities market. I find myself, being relatively well informed, and it's still hard to make those correct decisions and make ones that actually are going to make money. Now, we also have factors such as continuing monetary shift from the Federal Reserve. At least in the past 25 years, we have not seen them continually raise rates, and we have not seen them raise rates at this rate since the 1970s. We've seen two back-to-back 75-point basis rate increases in the money and the underlying lending rate of the Federal Reserve. So the intrabank lending rate, which essentially is going to trickle down to everything else. We're seeing mortgage rates rise up into the 5.5% to 6% region from where they were, let's say, November of last year when they were about 2.5%. So the expense of money is continuing to rise. The velocity of money is going to continue to drop. And this is effectively going to cause pricing of at least things on the securities market to have a little bit harder of a time in when they're trying to climb. So it's going to affect those prices. Now, we also have other big things coming out with maybe a potential big banking crisis happening in China with a lot of things to go with their housing market over there and being basically improperly underwritten, which can certainly trickle over into the United States market because they own a lot of US-based assets. So if these different players in foreign countries are going to start offloading assets, it's going to increase supply without a commensurate increase in demand, which is going to cause prices to drop as well. And again, I like to bring this up because it really goes to show that things outside of our control and things that we really don't have any you can't control what bankers in China are doing can actually affect the value of your retirement plan. Now, if you were to invest in something like real estate, you can certainly say, hey, they're building a Publix and a new gym, and they just repaved a road right here, and there's a good school right there. So yes, I can understand that there's going to be continued demand for families to want to come in and rent this house for a certain amount of money, independent of really whatever else is going on. And pricing of that underlying asset, once you've purchased it, doesn't really make too much of a difference to you. What happens in China, what happens in Eastern Europe, what happens with our current government is going to have very little effect on your ability to make cash flow out of an asset like that versus, trying to navigate this hugely complex world of securities investing. And again, this has been a relatively upward trajectory for at least the past few years. So the ability to make money has been very easy, but it's also going to get considerably harder, at least in my opinion, within the next few years. I think we're really kind of on the verge of some definite market corrections happening. Now, when market corrections happen, is there ability to make cash flow and make money in those types of situations? Absolutely. But understanding how to be, rather sophisticated with the stock market, I feel is definitely a lot harder than being slightly sophisticated when it comes to investing in real estate. And the barrier to entry to doing that is fairly large. You can go out and take a real estate course with some fantastic teachers for relatively cheap. Maybe a couple $100 get you a weekend with some really experienced real estate investors, as opposed to trying to understand the intricacies of options trading. Can be very hard, very complex, and even if you do take the time to educate yourself, is going to be very risky and very things move very quickly as opposed to investing in more tangible assets as well. So again, that's kind of what's playing into market uncertainty and just how complex and hard it can be to kind of crack the nut, especially in a more down market for investing in more traditional assets. Now, what we'd like to kind of illustrate is, the difference between how complex it is and how, and I hesitate to maybe really emphasize the word simple, but really just how much less complex it can be to identify ways to make money in more alternative asset classes. So what are some other options that people have? Well, a big thing we do here is rental real estate. So people that want to buy a property with their IRA, find a tenant and rent it out. Now, that's a great way to create cash flow because you have a contractual obligation from someone that is utilizing your asset to pay a certain amount over a certain amount of time. It doesn't take, a advanced degree in economics and finance to see, okay, you bought it for this, my costs are this, and my cash flow is this. You don't really have to understand anything else. And the other big benefit is you can reach out and physically place your hand on that asset. It's not this kind of ethereal concept of stock ownership that you have to wrap your head around or be familiar with. Most everyone is relatively familiar with real estate and can, with very little effort, kind of figure out a way to make money with it. Again, so real estate being kind of a lot of what we do, we see a lot of different shades of real estate, but most of the time people are buying single family, they're buying condos. You can do short or long-term rental. Airbnbs are extremely popular right now with our clients. People are making very good returns. And also, the ability to shift your strategy with a piece of real estate is very present. So you could go from having a single family home, and let's say people start vacationing more, or you start getting a bigger snowbird population or transient population in your area. You can certainly shift over to saying, okay, great, I want to go from single family to Airbnb and start doing more short-term rentals to create cash flow for my IRA. And that's a very easy transition to make, as opposed to trying to create a transitional structure for a stock portfolio. It's a lot more complex and involves a lot more steps than simply just deciding, okay, when this lease is up, we're going to put it on Airbnb and start getting more seasonal and vacation rentals. Also, if maybe you want to be a little bit more hands off with your real estate, there's the ability to do things like commercial real estate syndications, where your IRA just plugs in with another big group of investors and you have a managed asset that essentially just pays passive cash flow back to the investor, whether it be every quarter, every or twice a year, annually. You get to be a lot more hands off with these kind of things. So again, offering different kind of flavors when it comes to investing in real estate is one way that you can definitely find some certainty, especially if you don't want to deal with things like tenants and toilets. And let's say you really want to avoid things like liability, you really would like to be way more hands off and you would still like to control real estate or invest in real estate related assets. You can invest in mortgages, or in some states they're called deeds of trust. It's a very good way to maybe try to mitigate liability by not being on title to a piece of real estate, but also having an asset backed by real estate and still being able to create cash flow. And let's say you'd like to be really hands off and or maybe just change the direction of your investing. You could also do things like private business loans to people as well. You're not just kind of focused on just doing loans to people backed by real estate. There's a lot of different ways to kind of get those things deployed and make different decisions when it comes to how you lend out money. Now, one thing that I do run into a lot with people is the assumption that you have to have a certain type of IRA in order to do self-directed investing or invest in real estate or do things like this. And it's just not the case. A lot of people, when I talk to them initially, will think that you have to have a Roth IRA in order to do self-directed investing. And that couldn't be farther from the truth. While Roth IRAs are certainly a fantastic vehicle for you to invest in, they offer the ability to create truly tax-free wealth. They're not the only vehicle that you can use. What I have up here is a good illustration of all the different options that you can self-direct. You can do a traditional IRA. So if you want to roll over an old employer's plan and still keep everything tax deferred, dump it into a traditional IRA and you're good to go. If you do have a Roth IRA or you'd maybe like to do a conversion from traditional to Roth, you're absolutely allowed to do that. Now, let's say you're a self-employed individual and you would like to have the ability to have a retirement plan and also self-direct it. We can certainly do things like SEP IRAs, simple IRAs, solo 401k, or qualified retirement plan, record-keeping accounts. You can also self-direct health savings and education savings accounts. So the diversity that you can get in the types of retirement plans you can use for self-direction is vast. And I like people to understand that while, again, Roth IRAs are a fantastic vehicle, it is not the only vehicle you can use, and people are very successful in using almost any type of retirement plan that they have, and even health savings and education savings accounts to truly get that additional diversity and try to find some certainty when it comes to investing, especially in turbulent times. Now, getting started with these kind of things is very easy. And again, you're not having to take a distribution and pay taxes in order to do that. Essentially, the two accounts, whether it be your old 401k from an old employer or your existing IRA at another custodian, basically just transfers over either via transfer or direct rollover directly into a new IRA. There's no tax reporting done on IRA transfers. Any type of movement from an old employer plan is going to be tax exempt. There's no 10% penalty. There's no withholding that has to be done. It just is the exact same thing as moving from one wire clearing house to another, except for using our service, you are allowed to invest in true alternatives to, again, get that stability and create a little bit of a diversity profile within your retirement plans. And with that said, I'll turn it over to my colleague Scott, who's going to take it over for the next few slides.
Thanks, Alex. And I wanted to remind everyone, I actually forgot to mention at the very beginning, if you have any questions during the webinar today, please type them into the question box on your screen. So if you're listening live, if you put your question in the question box, we'll make sure that we get to it either during the presentation or at the very end. If you're listening to the recorded version of this webinar, certainly contact either Alex or myself, and we'll be happy to answer any questions. And what we want to kind of switch gears just a little bit now. Alex talked about the importance of maybe having cash flow and returning actual investment income back into your IRA. So we're going to go through a few case studies to illustrate how that happens, and using a couple of the different investment types that Alex mentioned just a few minutes ago. The first case study we're going to talk about is rental real estate. I would say it's probably one of the assets that we see clients hold, especially that produce cash flow on a monthly basis. I know when I first started back in 2006, rental properties, even some rehabs here and there, but actually buying a physical real estate was the predominant activity that I did when I was helping people with transactions and walking through the process from contract all the way through closing. And we're still seeing a number of people investing in these assets today. But this first case study is set up. We have John, who has about $250,000 in an old 401k account, and he finds a property that he wants to buy. It's in his neighborhood. So obviously, again, as Alex was alluding to, John may understand the demographics. He's going to understand his neighborhood a lot more and the potential for income for investing in that type of asset than maybe taking the time to learn more about stock market or researching different mutual funds. So he knows the area, he's comfortable with the area, knows he can get good cash flow from this type of an investment. His total investment to buy the property, get it fixed up and ready to rent, be about $150,000. Then he's going to just turn it into a full-time rental property. With IRAs and investing in real estate, one thing we didn't mention yet is if you are looking to use your IRA to invest in real estate, it does have to be for investment purposes only. You can't buy your own primary residence. But in this case, John's going to look at making this just a full-time rental property. So who does what? It's important to understand if you're looking to self-direct, what the responsibilities of you as the account holder are, as well as what responsibilities Advanta will fill as the custodian and administrator of your account. So John would fill out paperwork initially. The first step would be fill out the paperwork to open up his Advanta IRA account, and then request a direct rollover from his old 401k account. And as Alex just indicated in the last slide, rolling money over from the old 401k into his IRA is a tax-free movement of money. It's going from a like account to a like account. No tax consequence to John. The money just moves directly from his old 401k administrator to his new Advanta IRA account. Then from there, it is going to be up to John to find the investment property. And as the facts of this case bear out, he actually found the property first and then opened up his account and moved the money over. But when he goes to make the offer to purchase this property, he's going to want to make sure to do so in the name of his IRA account and then send the contract to Advanta IRA to actually sign on behalf of his IRA account. We'll go into a little bit more detail in the next slide on how exactly that works. He notifies his representative at Advanta that he's going to be purchasing this property. And then our role at Advanta will be to work with the closing agent, whether it's a title company or it's an attorney that is handling the closing, to ensure that there is proper titling on all the documents. Whenever you make an investment within your IRA account, whether it's real estate, precious metals, private notes or mortgages, we'll talk about in a moment, it's important to make sure that the titling for the investment reflects that your IRA account is the actual owner, just so that the IRS ever looks at your transaction. There's no tax consequence for you to make that investment. So we're going to make sure that the proper titling is not only on the contract, but then also on the deed, the settlement statement, any other ancillary closing documents. We're going to make sure that it's titled properly, and then send the documents, in this case, back to John to make sure he reviews and approves the entirety of the closing packet. So John's going to actually be the one looking at the settlement statement to make sure that he's paying his proper share of the closing expenses and the seller is paying theirs. He's going to initial off that he's approved of the closing documents, at which point we sign the documents, wire the funds out of his account to complete the purchase. And then going forward, we're going to hold the deed in our records, and we are going to receive all the income and pay expenses on behalf of John's IRA account. And just kind of go a little more detail about how some of that works. We'll get into the nuts and bolts of the presentation. Let me go back one moment here. Sorry about that one. A little too fast. So again, when you're buying real estate, it's important that the property is purchased in the name of the IRA. You can see the wording here on this slide, that the property, the actual title, the deed to the property is going to be listed as Advanta IRA, for benefit of, or abbreviated FBO, John Smith IRA, and his account number. Again, so that's the wording we need to see on the closing documents and from before we actually will sign and send any money out of the account. In this particular example, all of the funds for the purchase come from John's IRA, so his IRA is going to own the property 100% free and clear. But it is possible, if John didn't have enough funds in his IRA to make the purchase on his own, that he could be a partner, form basically a partnership with himself and other people. So his IRA could own a certain percentage of the property, he could own a percentage, or maybe some other third party owns a percentage, and the different parties will just share the income and expenses relative to their proportion of ownership. So we have certainly seen that happen many times with different investment properties, where 2 or 3 people may partner up together to buy the same investment. And if one person's using their IRA account, then we certainly would handle that aspect of it. But again, any income that's generated, whether it's the monthly rental and cash flow, whether John sells this property 5 or 10 years down the road, all of those proceeds go back into his IRA tax-free. There's no tax consequence. Just as if he was investing in a stock and sold a stock and had a gain, he wouldn't expect to pay taxes there. The same thing is true here with the real estate. It's just a different type of asset that he is using. And I mentioned a moment ago that the IRA, not only will it receive the income from the investment, and that's one thing in advance, we're going to receive that rental check each month from your tenant, deposit it back into your IRA account. Likewise, on the flip side, any expense, whether it's a property tax bill, an insurance bill, just regular maintenance items, those expenses need to be paid by the IRA account as well. So John, when setting up the account and deciding to make the investment, is going to want to ensure that he's got a little bit extra cash up front for any expenses that come up before the cash flow starts coming in. Now, to pay those expenses, you could, if you are handling the property and the oversight yourself, you can simply email us a copy of the invoice, or even better, log into our online portal, sign into your account, and you can direct the bill payment directly yourself. Actually type in the information that we will need to cut a check out of the account to pay the bill. The alternative you could use, and some clients do use, property managers who would collect the rents from your tenant, pay any expenses, and then forward the net rents back to your IRA at Advanta. But a lot of our clients, surprisingly, actually most of them just handle a lot of the aspects themselves. They deal with their tenants and direct their tenant to send us the rent check. And when expenses come up, they either email us the invoice or they log into their online account in order to get those bills paid. For maintaining the property, a couple things is just important to note. If you do have repairs, you do have maintenance that come up on a rental property inside your IRA account, that you as the IRA owner cannot perform any services on the property. You can't paint the house, you can't mow the grass, plumbing work, AC roof, whatever the case may be. The IRA owner is prohibited from doing the work. And extended to the IRA owner would also include the IRA owner's spouse and their children and grandchildren, or parents or grandparents. But as far as who can do the work, anyone who's not considered disqualified, which are the people I just named, basically the IRA owner and their close family members, they are the people that can't. Anyone else can do it. It does not have to be um, someone who's necessarily licensed. If you're comfortable hiring somebody who is not officially licensed, that's up to you. You can certainly inspect the work, decide who you're going to hire. But again, the requirement is simply that you're not the one actually doing the work itself. And then renting the property, again, who gets the cash flow? Your IRA does. As I mentioned already, the income that's generated comes back into the IRA account. When you're renting the property, I mean, if you're not using a property manager, then you're the one selecting and qualifying your tenants, making sure you're comfortable with who you're renting the property to. You would send a copy of the lease to Advanta for us to sign on behalf of the IRA account. And then you want to include in your lease direction for the tenant to send their monthly rent check back to Advanta for deposit directly into your IRA account. So it's up to you to negotiate the terms of the lease with your tenant. Again, you as the IRA owner are going to be named as the contact if the tenant has any issues. Obviously, reach out to you if there's any maintenance items or other things that they need to talk to. That's something that we don't handle at Advanta. But if that's a little too much, that's something you want to take on. Again, you can certainly employ a property management company to handle those particular issues, not only in selecting and qualifying the tenant, but then handling any issues going forward. Now, for this particular client that we had, after he got the property purchased and ready for rent, he net cash flowed $1,500 a month. So his IRA was receiving the rents, we pay the bills, and so that cash flow was just coming back in his IRA every month. So not only did he get, he has potential for growth and appreciation of the property, he simply gets the cash flow every single month. So unlike a stock where maybe you're looking at, with that stock is growing in value and you're going to have to sell it, this real estate is putting off a $1,500 dividend every month back into his IRA account. Now, again, if he sells the property down the road, again, profits will come back to his IRA tax-free. And again, no tax is paid on the rental income. And the profits will remain inside the IRA tax-free, just as you would inside a brokerage account if you were buying and selling mutual funds or stocks. Same thing with the real estate. If you sell the real estate, the money is still inside your IRA, ready for you to make other investments. The cash that's coming in each month, that $1,500 a month as it accrues, he could certainly use that cash to maybe buy a new property. If he wanted to, he could move that money back into a brokerage account. You could send it right back to a Vanguard or Charles Schwab or someone like that to have that cash invested. You could certainly choose a different asset as well. Some of our clients, it's not an option on this screen. I think we have it another example, but the other option you'd have, and a lot of our clients who are over the age of 59 and a half and allowed to take penalty-free distributions, that cash flow comes back into their IRA each month, and they take all or a portion of that money and have us distribute it to them to use for their living expenses, for their vacations or whatever they may choose. Before I hand it back over to Alex, I think we had a couple of questions came in. One of them says, for the transfer of assets from existing financial institutions to Advanta, does the rollover need to be liquidated first, or can you transfer the mutual funds, stocks, and cash to Advanta? The answer to that question is, since we are not a broker dealer, you do need to liquidate any holdings first, and then have your other custodian either transfer or roll over the cash to Advanta IRA. So we cannot take any mutual funds or stocks. So that could be a matter of you timing the market. If you're somebody who's looking to invest in real estate and you haven't identified the property yet, we always advise getting an account open. You could transfer over just a few $1,000s to have for an earnest money deposit if you do locate a property. And then once you get a property under contract, you can do a bulk transfer later on. But yeah, if you're going to move money, it has to come over in cash. Another question: will the slide deck be available? Absolutely, we can send that out to anyone who wants it. It's not a problem to provide a slide. And a kind of a tax-related question: is depreciation something to include? That's a great question. With self-directed IRAs, if your IRA owns a property free and clear, then as I've mentioned a few times already, the IRA is not going to pay any taxes on the income. And likewise, then the IRS does not permit you to take any depreciation on that property. So that is one thing that you lose to an extent when you're investing in real estate through your IRAs. You do not get the benefit of depreciation, but on the flip side, you're not paying taxes. Your IRA is not paying taxes on the income that is flowing back in. The one time you're allowed to take depreciation inside of the IRA account is if you use your IRA to buy property that has a mortgage attached to it. There's a little known tax that you can get into. Your IRA could be subject to called UBIT. In fact, Alex just did a great webinar a few days ago on that. You can find that on our YouTube page. But typically depreciation does not come into play in these particular instances because the income, again, to the IRA is tax-free. With that, Alex, again, great questions. Keep them coming. If you have any more before the end of the webinar, please get those typed in. We'll make sure to get them addressed.
Yeah, thanks, Scott. Yeah, and I would encourage anyone, especially at the last point, if you have questions on different tax strategies, the webinar I did on what's called UBIT and UDFI taxes on Tuesday, which is up on our YouTube channel, youtube.com/Advanta Largo, is a really great thing to give a listen to. So with that said, let's go ahead and get into our next case study, which is private lending, which is one of the areas, especially for those of us that want to invest in cash flow, but want to obviously try to mitigate our liability exposure and maybe just the exposure to having to deal with additional headaches that kind of come with real estate investing, things like tenants, toilets, getting woken up in the middle of the night because, someone decided to try to put a grease fire out with some water. If you don't want to deal with that kind of stuff, private lending can be a really great way to have real estate backed or real estate controlled assets within an IRA while not having to deal with all those other kind of small minutia of owning real estate. So in this instance, we're going to kind of look at what it looks like to do a private loan within an IRA. Now, in this case, Andrea has $150,000 in her IRA and she wants monthly cash flow. And she doesn't want to necessarily deal with having to do a whole rehab project, but she meets Steve at a local investor group, and Steve wants to acquire a piece of rental property for about 200 grand. He has enough for the down payment, needs to finance the rest. So in this case, Andrea is going to do her due diligence and figure out that this is a good deal that works for her. She thinks the after repair value is going to be right. Everything looks right with regard to Steve's ability to make the payments and fulfill his end of the agreement to repay her IRA. Now the benefit on this is that, let's say Steve's project goes south or he can't repay or something happens, Andrea has the ability not just to lose her underlying investment, she gets to foreclose on the property, and then her IRA would take in the real estate as a foreclosure action. So again, a great way to kind of hedge against a potential issue with a piece of real estate or with a particular investment by having actual physical collateral to it. And I think we're all kind of familiar with mortgages in some form or fashion, and this is again doing a mortgage through your IRA. So in this case, Steve's going to give Andrea's IRA a mortgage on the property as collateral, and then they get to decide on the terms. Another really great benefit to doing these types of investments within an IRA is that there's no one prescribed method for doing it. You get to work with the borrower and within your own set of criteria to make sure that it's something that's going to work for you, that you're okay with the rate of return, that you're okay with the collateral and the scope of the project or whatever they're doing. Excuse me, you get to actually decide on all these different factors, which is really phenomenal because in no shorter terms, you get to really decide what your rate of return is for your IRA. You get to actually say, you know what, this is exactly what I'm going to be making, and you have that security and comfort in knowing, hey, this is exactly what I'm going to be making. This is exactly the rate of return that I'm going to be expecting on this. And hey, if it doesn't work out, I get a piece of real estate as repayment for my investment. So with private lending, you get to, again, determine all of the factors of this. And I'm not saying this just to kind of be, coy with it. Every single thing you get to determine on this. You get to determine the amount of money that you're going to lend out. You can lend out. We have people that do small transactional lending of like $1,000, $2,000 notes to people, all the way up to we have people with multi-million-dollar loans that have been issued out of their IRAs for very large projects. So you get to choose exactly how much you want to lend out. It's not something where you have to say, oh, well, if something is trading at a certain share price, I have to have at least enough money to buy that to buy that security. You get to really kind of figure out exactly what's going to work. And if you have money in that scope, then great. And even if you don't, maybe you could even bring in partners to do something as well. You also get to determine your rate of return, which is the interest rate on the note. And this can be anything from extremely cheap or in some cases where you might have consideration being done in lieu of an interest rate. You can charge really whatever you'd like to as an interest rate on a note, with one caveat is that anytime you do a note, there are typically laws in every single state in the nation that are what are called usury laws. And these are going to determine the exact amount of interest that can be charged on a particular note. Now, typically, these are going to be, very high interest rates. Most of the time, once you start getting into the realm of like 18% plus interest on a note, that's when you're going to need to make sure that you're, determining that usury is not being violated. But for the most part, if you're staying, below that line, most people are okay. But again, I can't stress this enough. You need to check with the particular state, check with an attorney to make sure that whatever you're going to be charging as far as interest on a note does not violate that, because that is definitely not something you want to get involved in with regard to, being in violation of a usury action in a particular state. So just understand that you can determine the interest rate of your note. Obviously, it's need to be something that works for the borrower. If they don't have the ability to repay, then you're kind of setting yourself up for failure. But also the fact that you're not violating any laws. And again, all states are different. I just kind of gave those two examples as a general guideline. Once you start getting up, past about 15% interest on a note, then make sure that you're checking with stuff, because that's where kind of the majority of those start to kick in. Now, you also get to determine how long the note is going to be out there for, or the period of the note. So you get to say, okay, great. I want to lend someone money and I want to make sure that I recoup all of the money, get my underlying interest and principal back in 5 years. Great. You can set a maturity date of 5 years. You can set something where there's going to be balloon payments, or it's going to be interest only. There's all the different factors of the note you can bake into that. We have clients that have done 30-year mortgages. We have clients that have done 6-month direct unsecured personal loans to people. So the ability to really customize this is awesome, and especially for how long you have the money out there for. Now, you also get to determine how often the note is going to be paid. Is it going to be principal and interest? Is it going to be interest only? Are they going to make monthly payments, biannual payments, quarterly payments? All those kind of things, again, can be customized. Equity participation is also a really interesting thing that I've seen, especially more common in the real estate market, especially in maybe the context of Andrea's deal, where they are doing a rehab project where maybe instead of a stated interest on the note, so maybe the note is going to be 0% interest on the actual money, but instead of the actual interest being paid, the consideration is a certain percentage of the profits at the sale of the property. So that's also a really cool way to bake in some ability to be exposed to the appreciable gain in value on the property, instead of just only kind of boxing yourself into only being able to get the interest rate that is stated on the note. So equity participation is a really cool thing that a lot of people are using, and I would encourage people to do some more research. And also, going back into my comment about usury, some states you do have to compound any additional considerations. So things like equity participation in the factor of how much interest you're getting. So just be aware of that. Again, lending can be a very straightforward and simple way to invest in real estate, or actually invest in a more hands-on approach with self-direction, but there are some laws out there that you will need to be aware of that aren't necessarily IRS rules, that are maybe state governance laws that you need to be familiar with to make sure you're not violating anything. And then also, maybe you want to bake in a prepayment penalty, or if you want to have something like fees or origination points that are baked into the loan. I've also seen people get their custodial fees paid for by the borrower as part of the note package, by saying, hey, you know what, here's the principal and interest, and since this is a 5-year note, part of the origination fees are all the fees that I expect to pay to my custodian Advanta for actually making this note as well. So a lot of clients that do lending through their IRAs can essentially get all of their custodial fees paid by the borrower as well. So really kind of cool ways to really be flexible with these things and really make a good financial situation for your IRA by being in a lending position on an IRA asset. Now, what do actually the terms of this note look like? Because remember, Andrea gets to determine exactly how this thing is going to go for her IRA. So what exactly does it look like? So she's lending out $150,000 at an 8% interest rate, a 2-year interest-only balloon note with a $1,000 a month payment. And there's, again, a recorded mortgage on the property. With regard to the note, Andrea's attorney prepares the note and mortgage. She reads and approves all the documents that are sent to Advanta, completes a few forms, and essentially that's what we need in order to go ahead and fund escrow on the loan. So what does cash flow look like with this property? Steve rents the property for $2,500 a month, sending $1,000 to Andrea's IRA every month. If Andrea is over 59 and a half, she can take the monthly $1,000 cash flow as a distribution and use it as she wishes. So if this was a Roth IRA, she pays zero tax on that distribution. So she'd just be getting tax-free cash flow, which again is awesome and kind of one of the reasons people think that you need a Roth IRA to do this. But it certainly isn't the case. You would just pay, a small portion of taxes on, in this case, the $12,000 a year she takes out if she took every $1,000 cash payment or cash flow payment out. But she also doesn't have to. Maybe she only needs a couple of those payments, so she'd only pay a very small amount of taxes on just what she extracted, or just leave it all in there and just continue letting it compound tax exempt or tax deferred. And then when the 2-year balloon hits, Andrea could extend the note. She could continue the cash flow. She could have Steve refinance the property and return the capital to her IRA. There's really a bunch of different options. She's under no obligation just essentially to call the note due. She could work it out with the borrower if she's happy with getting that cash flow, renegotiate the terms of the note, and maybe put it out for another 5 years. If she likes that $1,000 a month she's getting on her 150, then all the better to her. But again, there's a large degree of personal preference, and you really get to customize and fine tune this stuff exactly how you want. Again, trying to get that certainty back in your life with regard to your investments. This is a great way to do it, and a very good example of exactly how profitable and solid an investment strategy like this can be if you feel that it's the best route forward for you. Now, with that, before I turn it over to Scott, we have some questions, or one at least. So we have, how does the RMD work when collecting monthly cash flow, and what amount determines the RMD in an IRA like this? Great question. So required minimum distributions are based on the value of the account, so the cash plus any underlying assets, as of 12/31 of a given year. So 12/31, you use the snapshot value, and that determines how much money you need to take out in the following year for that required minimum distribution. Now, with an asset like this, so if the underlying note is still worth $150,000, if it's interest only, and that's basically what the note is worth. Now, the client in this case is responsible for reporting back an accurate value of any underlying assets to the IRA, because the IRA administrator, in this case Advanta. So once we take into account the cash in the account as of 12/31 plus whatever values are in the account of that date, then that gives you the ability to calculate the required minimum distribution using the IRS required minimum distribution calculation tables. Now, what you do need to keep in mind is that required minimum distributions are a calculation based on the value of all of your pre-tax IRA retirement plans that you have. So if you have, in this case, Andrea's $150,000 IRA, but she also had, let's say, a $200,000 IRA at a wirehouse, then you would have $350,000 of total value that you need to use to calculate the required minimum distribution. And you could take that RMD from another account. Again, if she had an account with a brokerage, she could satisfy the RMD for all of her accounts out of that account if it was a little bit more liquid, or maybe she didn't have the cash here to satisfy it. You don't have to individually take RMDs from each individual IRA you have. It's a total calculation, and you can satisfy it from just one account. But great question. With that said, I'll turn it back over to Scott.
All right, thanks, Alex. And so, as we've talked about a couple, this past example Alex talked to about the private lending, and then this next one we're going to go to when it comes to multifamily. It's, Alex mentioned, a lot of people don't understand the stock market or really have the time to devote to learning what they need to know to invest, smartly or prudently when it comes to stocks, bonds, and mutual funds. And sometimes even in real estate, people don't have the time to spend, like in our first example with John on a rental property, to take time to find his tenants, arrange for things to be done maintenance-wise with the property. So I think these last two examples, the one Alex just covered on private lending and this example on multifamily, is another way to illustrate how you can get cash flow back into your retirement account with not needing a whole lot of effort. So in this particular case study, Jane is a syndicator, a multifamily real estate investor, where she has identified and found an apartment complex that she needs to wants to buy, remodel, and then hopefully then just start raise the rents, get the properties hopefully cash flowing quite a bit more than maybe they were already. And for this syndication, she's looking to raise $1 million or so in private funds to then go to the closing. And she's looking for investors, and she meets John, who's got 100 grand or so in his Roth IRA with Vanguard. And so again, getting back to how Advanta does not do, we don't provide investments, we don't do due diligence. It's going to be up to John to look over the subscription documents. So Jane will present him with her kind of outline, her overview of the project, what she projects as far as returns for her investors. John is going to have to look through that and be comfortable with the investment and Jane's projections for this particular investment deal. Presumably, he looks it over, he's satisfied, it's something he wants to be a part of. And maybe John is somebody who works 9 to 5 and doesn't have the ability to, go out and find real estate properties on his own, but he wants to be involved, looking for a better rate of return, maybe looking for some cash flow back to his account. This type of an investment is well suited for him because he needs to really just do some initial work up front, evaluating the opportunity, deciding to invest, and then just putting the ball into motion. And at that point, sit back and collect his cash flow. So John will need to fill out the paperwork with us to open up his Roth account that establishes the account, names his beneficiaries, and then request that transfer from his current Roth IRA at Vanguard over into his new Advanta Roth IRA. Our role will certainly submit the paperwork to Vanguard and then notify John when the funds arrive. And as far as the investment process, similar to the other examples that we've seen, it's going to be important that the subscription documents for this investment show that John's IRA is the actual investor. So the subscriber's name, again, would need to read Advanta IRA for benefit of John's IRA account. And the tax ID number that will be used on those documents will be Advanta's trust tax ID number, not John's social again. So any tax reporting that comes from this investment, the K1 that gets issued each year from the syndication itself, will go back to John's IRA account, not to him personally. Ultimately, we sign the subscription documents, send the wire to fund the investment, and then Jane collects all of her investors' funds. She closes on the deal, rehabs the property, gets rents flowing at a higher rate, and then starts sending dividends back to their different investors. In this case, John's Roth IRA gets $2,000 every quarter, simply flowing back in his IRA. The $8,000 a year then is, again, tax-free returns back to his Roth IRA account. His principal amount is still invested at the full $100,000. And as is the case with a lot of multifamily syndications, the goal is to get the property performing, or get the rents raised, make the property more attractive to maybe a potential future buyer. And so if Jane sells that property and sells that apartment complex in a 3 to 5 year period, John's IRA will have received all these tax-free dividends. And then on the sale of the property, the extra amount that he will get for his portion of what he owned in the real estate, again, all coming back tax-free to his Roth IRA. So again, like the private lending example for this one, John is able to be a little more passive, right? He doesn't have the time to devote to managing a rental property or managing a stock portfolio, but it gives him the ability to still make an investment into maybe something he understands and still receive that important cash flow back in his IRA, leaving that principal amount unaffected. So as we wrap up here, again, if anyone has any other questions, please get them typed into the chat box. We'll make sure we get them answered. But it's an easy process to get started. It's a matter of filling out the paperwork to open up the IRA account, getting the funds transferred or rolled over from your other plan, and then ultimately start investing and finding the investment and directing your account manager at Advanta to purchase your particular investment. For a lot of our clients, they come to us with step 3, right? They've already located the investment, found something they want to put their IRA to use in, and then we help them go back to step 1 to get the account opened, get it funded, and ultimately then get that particular investment made. We did have another question that pops up. Someone says, do you have to set up an LLC basically for your self-directed IRA? Now, that is something we did not cover in today's presentation. There is a mechanism called the Checkbook Control IRA or the Checkbook Control LLC, whereby you can use a newly formed LLC with your IRA as the sole member to make all of your different investments. And by setting up that type of structure, your IRA is the member of the LLC, and we send the cash from your IRA account to a bank account that you established for the LLC. And then as a manager of that entity, you can then make all of the same types of investments that you would make through the IRA, you make it through the LLC, giving you a greater degree of control over those particular assets. So, but the answer to your question is you do not have to set up an LLC. You can, as we've shown through the case studies today, that you can make the investment simply directly in the name of the IRA account, but the LLC is an investment option. If you're looking for more about the checkbook control, please go to our YouTube page. We've done numerous webinars on that topic that go a deeper dive on how you set those up and some of the other advantages of doing so. The last thing I wanted to mention today, before we get to any last questions that come in, I wanted to just let everyone know we do have an event. And I mentioned, and I think Alex mentioned as well, that we cannot really solicit investments. We don't promote investments to individuals. So if you're an Advanta account holder, we're never going to come to you with an investment opportunity asking for you to take a look at it or consider it. That's not something we're able to do. And likewise, we cannot help you find an investment. If you're looking for an investment, we're not going to point you in a particular direction. But when it comes to what we can do, we have an event called Pitch, Promote, and Prosper. It is an online investment marketplace and networking event. We do every other Friday from 12 to 1:30 or so noon, or so 12 to 1:30 Eastern time. We allow everyone that attends to have a minute or two to either say what they're looking to buy, if you're out there looking for a particular type of asset, when let the group know, or if you do have an investment that you are selling or promoting. You can come on to that investment marketplace, pitch that investment to a book. We obviously disclaim any liabilities for any investments or things that happen at that event, but it is a way to, at least to get people together and sharing some ideas and sharing some different types of events. So that event is every other Friday. If you haven't been to it, I'd recommend just attending at least once, get a feel for it, see what people have to buy and sell. And at that time, I think we'll open it up to any last questions that we have. Alex?
Yeah, no, again, thanks everyone for joining with us today. The one gentleman that asked about setting up an LLC, I actually just kind of covered a little bit of a different take on checkbook control LLCs and the like on our podcast. So if you like things in podcast format, you can find the Alternative Investing Advantage podcast on wherever you get your podcasts. But that was one of the most recent ones I just did. So if you like to learn a bit more about that, that's a great place. And then we also had a question, can I sell a property to the IRA? So great question. Unfortunately, when it comes to acquiring properties or any assets with an IRA, it has to be done at arm's length, meaning that if you personally own a property, you cannot sell that property, even if it's at a certified market appraised rate or value, you cannot sell it to your IRA. It has to be purchased from some third party. And you also can't buy it from your spouse, your mother, father, or son, daughter, what are deemed disqualified individuals. So it has to be arm's length from someone not in your immediate nuclear family with regard to how you acquire, any asset. And that's not just real estate, that's notes and mortgages, that's, anything else you can imagine. But unfortunately, you could not sell that property directly to your account.
Well, again, if anyone has any other questions that they haven't got a chance to type in or weren't able to, or again, if you were listening to the recorded version of this particular presentation, here's the contact information for both Alex and myself. So if you want to reach out to us separately with an email, or if you want to give us a call, we're happy to walk through your individual scenario or questions you have really on anything regarding IRAs, whether something we talked about today or maybe something that we didn't cover. Another question popped up, said, who participates in the marketplace, our Pitch, Promote, and Prosper event? Alex, you can probably speak a little bit better to that than I can, but it's just a number of different individuals, whether it's some are, I think some people are IRA account holders, other people are promoters, other people are just other real estate and other types of investors just looking to get an idea what's out there.
Yeah, I think you kind of hit it right on the head, Scott. It's a really large cross section of people. Everyone from people putting together syndications and soliciting investors for private stock offerings to people just trying to sell their single family homes or looking for homes or really anything. It's a fantastic cross section and a really good melting pot of different investors and ideas. So if you're interested, I'd always encourage anyone to participate. Again, it is absolutely free. So if you get on there and 10 minutes in, it's not your cup of tea, sorry that it wasn't a good fit for you, but we rarely had anyone come and not get some benefit out of it. So we'd encourage you to come. It's got investors from all over the world. We've have a regular participant that's out of Southeast Asia, out of Hong Kong. And we have people from all over the United States, Europe, Central South America. It's a really cool group of people that get together on it. So we'd encourage you to take a chance on it and sign up for one of our every other Friday Pitch, Promote, and Prospers.
All right. Well, thank you again for everybody attending. Alex, it was a pleasure sharing the webinar with you today. And I encourage anyone who is interested in learning more about either self-directed IRAs, again, topics maybe that we didn't cover, either you can give Alex or I a call. You can head to our YouTube page, which has all of our past recordings of webinars and topics. Alex mentioned his podcast, The Alternative Investing Advantage podcast, where he has a lot of different guests. We have a lot of good educational material out there, so please take advantage of it. And again, sometimes the easiest thing to do is pick up the phone and give us a call. So with that, Alex, you have any last words?
No, again, thanks. I always enjoyed doing these with you, Scott. If anyone has any questions, let us know, but we'll let you all get back to your day. Have a great one.
Thank you.